Have you ever wondered if you're paying more taxes than you need to? Most Canadians miss out on valuable tax deductions and credits every single year, leaving hundreds or even thousands of dollars on the table. Today, I'll show you 9 easy ways to reduce your taxes this tax season. Tax deductions versus tax credits. Before we jump into the specific tax deductions and credits, let's quickly clarify the difference. Tax deductions, also known as tax write-offs, lower your taxable income, which is then applied to the tax rate to get to your tax bill. Tax credits. Tax credits directly reduce the amount of taxes that you owe, but they're calculated by multiplying the eligible amount by a specific tax rate, like the federal tax rate of 15%. If we are to tie everything together into an example, let's say your salary is $60,000 per year without any deductions or credits. Then your total tax liability in Ontario would be $13,441. Now, if you have $10,000 of tax deductions, your taxable income gets reduced to $50,000. This also brings down your tax bill to $10,912, which is $2,529 in tax savings already. Then, if you have tax credits of $10,000, you would need to apply a specific rate. Let's use a 15% federal tax credit rate. So your actual tax savings is $1,500. This means your tax liability gets further reduced to $9,412. Overall, by using a combination of tax deductions and credits, you saved $4,029 in taxes by reducing it from the original tax bill of $13,441 all the way down to $9,412. Now that you understand the difference, in this video we will discuss types of tax deductions and tax credits that you can claim on your tax return to reduce your taxes. So let's start with tax credits. The first tax credit is the first-time homebuyer's tax credit. If you are a first-time home buyer, you can claim $10,000 for your first home purchase. This means that you get to reduce your taxes by $1,500, which is the $10,000 times the 15% federal tax rate. If you bought the home with a partner, you have to split the $10,000, or one person can claim the entire amount, but both of you cannot claim more than the total of $10,000. The second is the tuition tax credit. If you went to a post-secondary educational institution like a university, you can claim tuition credits. Even if you don't have income in the year to use the tuition credit, I highly suggest that you still report it so that you can carry forward it to a future year when you do have income so that you can reduce your taxes then. Alternatively, you can even transfer a maximum of $5,000 of your tuition credit to someone who actually has income to offset it, like your parent or spouse. Eligible tuition fees can include any of the following amounts that I'm going to include on the screen. If you have paid for tuition, remember to obtain the form called the T2202 Tuition and Enrollment Certificate from your educational institution. That way you know exactly how much to report on your tax return. 3. Medical expense tax credit. Medical expenses paid out of pocket, such as dental care, travel expenses, and medical supplies, including air filters, can be claimed on your tax return. However, there is a catch. Only the medical expenses exceeding a certain threshold can reduce your tax bill. Before you go through the hassle of combining all your medical expenses, do a quick check to see if it's even worth your time in the first place. You can only claim medical expenses that exceed the lower of 3% of your net income, or $2,759, which is the CRA threshold for 2024. Just to go over an example, if your net income is $60,000, then 3% of your income is $1,800, which is a lower amount than the CRA threshold of $2,759. So using our $1,800 threshold, if you incurred $1,000 in out-of-pocket medical expenses, none of these would qualify since it's below the $1,800 threshold. If you incurred $2,000, however, in medical expenses, you could claim $200, which is the $2,000 minus the $1,800 threshold. Basically, in this example, it would only be worthwhile to report your medical expenses if it exceeds $1,800. To maximize your claim, you could select any 12-month period ending within the tax year. For instance, if you didn't claim medical expenses in 2023, you could choose a period from February 2023 to February 2024 on your 2024 tax return. You can also combine the medical expenses for yourself, your spouse or common law partner, and dependent children to further maximize your tax credit. 4. Charitable donations tax credit. Donations to registered charities, including religious organizations like churches, are a great way to support causes you care about, and they also provide you with a valuable tax credit. Here's how the charitable donation tax credit works in Canada. You receive a tax credit based on the total amount donated during the tax year. The federal portion of the credit is calculated as follows: 15% on the first $200 of donations, then 29% on donations over $200, and a higher rate of 33% may apply to donations if you're a high income earner. Additionally, you receive a provincial credit based on your province's rate, further increasing your tax savings. Just to give you an example, the table here summarizes the tax credit that you could claim on the first $1,000 of donations. In Alberta, it can be upwards of $550, and in BC, you can receive up to $406.52 of tax credits, which directly reduces your taxes. Now, remember that you need to make donations to qualified donees like registered charities in Canada or any on the list over here. If you're unsure, you can always search them up in the list of charities on the CRA website, which I'll provide down in the description box below. To maximize your donation tax credit, you can also pool your donations with your spouse or common law partner on one tax return. Also, make sure to receive official donation receipts issued by the registered charities in the case of an audit. Now, if you need to pay taxes, why not get cash back or credit card points while doing it? Chexy now offers a way to pay your taxes using your credit card. I've previously partnered with Chexy on paying your rent with your credit card, but they are now offering a way to pay your taxes, which is a game changer to hack the system. For example, let's say that you have a credit card that offers great perks like the Scotia Momentum Visa Infinite, which offers a 4% cash back. Paying $10,000 in taxes would earn you $400 in cash back. After the 1.75% Chexy fee of $175, you still pocket the difference of $225 in cash back, and all you did was pay your taxes. If you're into points, you can use a card like the TD Aeroplan Visa Infinite Privilege, which offers you 1.25 times the points. And the same $10,000 tax payment would earn you $12,500 in Aeroplan points. That's enough points for a one-way flight from Toronto to Costa Rica or Vancouver to Cabo, Mexico. Chexy makes the process super simple. You create an account, choose a tax payment you want to make, and enter your social insurance number, which is securely encrypted and stored only for payment processing. Select the amount you owe and your preferred card, and 3 business days later, Chexy will submit your tax payment to the CRA or Revenue Quebec. It's the only way to earn rewards while paying your taxes. So use my link in the description box down below to pay your taxes with Chexy this tax season. A quick but important disclaimer: using a credit card only makes sense if you can pay it off in full each month so that you can really take advantage of the benefits. You definitely don't want to go into credit card debt, which can charge you 20% in interest. So with that out of the way, let's continue with tax deductions. So the 5th way to reduce your taxes is through the childcare expense deduction. If you have kids and pay for childcare, the lower income spouse can claim the expenses on his or her tax return. Allowable childcare expenses you can claim are caregivers providing childcare services, day nursing schools and daycare centers, educational institutions for the part of the fees that relate to childcare services, day camps and day sports, schools where the primary goal of the camp is to care for children, boarding schools, overnight sports schools, or camps where lodging is involved. If you incurred any of these expenses, you would receive a receipt of total childcare expenses paid in the year by the childcare provider, which you can then report on your tax return. 6. Home office deductions. Working from home has become very common, and while the temporary flat rate method from COVID days are no longer available after 2022, you could still claim actual expenses you have incurred using the detailed method. Though you do need to be required by your employer to work from home and have a form called the T2200 Declaration of Conditions of Employment from your employer on hand. You need to determine your home office use percentage by taking your workspace as a percentage of your total home. Now, if you use a common space like a living room instead of a designated room for work only, or even share the space with multiple workers, such as both you and your partner work from home, then the home office use percentage will be further reduced. For more guidance, I will provide a calculator you can use by the CRA in the description box box down below. Home office expenses that all salaried employees can claim are electricity, heat, water, utilities portion like electricity, heat, water of condo fees, home internet access fees, maintenance and minor repair costs, and rent paid for a house or apartment where you live in. If you are a commission employee, you can also claim home insurance, property taxes, lease of a cell phone, computer, laptop, tablet, fax machine, etc. that is reasonably related to earning commission income. However, some home office expenses that you cannot claim are mortgage interest, principal mortgage payments, home internet connection fees, furniture and capital expenses, as well as wall decorations. 7. Moving expense deduction. If you moved for work or school, you can claim your moving expenses as a deduction. However, you need both of the following apply to you. 1. You move to a new home to work or to run a business out of a new location, or you move to be a student in full-time attendance in a post-secondary program at a university, college, or other educational institution. And your new home must be at least 40 kilometers closer to your new work location or school. And if these apply to you, then the types of moving expenses you can claim are transportation and storage costs, travel expenses including vehicle expenses, meals and accommodation, temporary living expenses for a maximum of 15 days, cost of canceling your lease, incidental costs related to your move like changing your address on legal documents or replacing your driver's license, as well as utility hookup and disconnections. You could also deduct costs related to maintaining your old home when it's vacant up to a maximum of $5,000, only if it's not rented and nobody is living in the home. You could also deduct costs of selling your home like advertising, legal fees, real estate commissions, mortgage penalties, as well as costs of buying the new home. The list is quite extensive, so I'll make sure to include the CRA link below for you to check out. You can even claim moving expenses in the year that you pay them, even if it's in the year after you moved. So if, for example, if you moved but your previous home didn't sell until the following year, you could deduct expenses related to that. 8. Interest expense, investment fees, and accounting fees. If you borrow money to invest or pay someone like a financial advisor to manage your investments for a taxable account, you can claim these costs as a deduction. If you earn investment income, the deductions you could claim are fees to manage or take care of your investments, fees for certain investment advice, to have someone prepare or assist you in filing your return if you have income from a business or property, and income from property can mean income from stocks or rental property. And most interest you paid on money you borrowed and used to try to earn investment income, such as interest and dividends. An important thing to know here that I want to really emphasize is that none of the expenses mentioned can be claimed for non-taxable accounts like your RRSP or your TFSA or your FHSA. Since investment income in these accounts are not taxable, you also can't claim expenses related to them. You could only claim expenses in your taxable or non-registered accounts. 9. FHSA and RRSP contributions. Making contributions to your FHSA, which stands for the First Home Savings Account, or your RRSP, which stands for your Registered Retirement Savings Plan, are tax deductible. And of today's list of tax deductions, this is an amount that you can voluntarily choose to contribute and actively plan to not only lower your taxes, but invest for your future. And if you're curious about how these accounts work, I go into way more details on what an FHSA and RRSP is in a video that I'll link over here. And that's it. 9 simple ways to save money on your taxes this year. Let me know in the comments which of these tax deductions or credits you'll be using. And if you have taxes owing this year and you want to earn some cash back or credit card points for travel, then make sure to use my link with Chexy in the description box down below. And if you want to learn about recent tax updates or how to easily open an RRSP account, make sure to check out my videos over here. Thank you so much for watching, and I'll see you guys in my next one. Bye!